Look, I spent thousands of hours over the course of my 6 years of trading watching YouTube content from ICT, SMC and retail trading, and I would kill to have a simplified strategy that is easy to understand and uses just a few powerful concepts to be consistently profitable. And if somebody were to actually provide a robust strategy with clear explanations on how to use them with examples, I would have been able to become a profitable trader so much quicker. So that is why I made this video. I'm going to break down an ICT breaker block strategy with clear explanations and examples on how to implement them into your trading arsenal. So sit tight, take down notes, and let's get right into the video. Before we get started, there are 3 core concepts to master before we dive into the strategy. The first concept is market structure shift. A market structure shift is a pattern that happens when the market has intentions to reverse. In the markets, there are 3 types of market structure: a bullish market, a bearish market, and a ranging market. A bullish market creates higher highs and higher lows, allowing price to constantly push price higher. Higher lows are put in place to protect bullish trends from coming lower. So as long as the higher lows do not break, the bullish market structure will remain bullish. A bearish market, on the other hand, happens when the market creates lower highs and lower lows, allowing price to constantly push price lower. These lower highs are put in place to protect the bearish trend from coming higher. So as long as the higher lows do not break, the bearish market will continue to remain bearish. Now, the last market structure is the ranging market. This happens when the market tends to consolidate in an area, not creating higher highs or higher lows. It is stuck within 2 zones, commonly known as support or resistances. For this strategy, we will only be using the bullish and the bearish market structure. For a market structure shift to occur, there are 2 scenarios to take note of. Scenario number 1. In a bullish market, I want to see a break below the higher low. It is really important to note that if the break of a higher low is a wick, it means that it isn't a proper market structure shift. It indicates that price does not have enough volume to push lower below the higher low. What I want to see is a body candle closure below the higher low. Only then will a market structure shift to the downside be valid. A body candle close tells us that the market is looking to reverse strongly, as there's enough volume to close below the higher low. Scenario number 2. In a bearish market, I want to see a break below the lower high. Similar to scenario 1, I must wait for a body candle close above the lower high in order for me to consider this a market structure shift to the upside. Remember, no wick closes, only body candle closes. When these scenarios happen, you have a shift from a bullish market structure to a bearish market structure in scenario number 1. And for scenario number 2, you have a shift from a bearish market structure to a bullish market structure. Moving on to the second concept, order blocks. Order blocks represent a manipulation in price that happens before an impulse move. Let me give you an example to illustrate my point. Let's say that I am a bank with $10 billion. Basically, I have a lot of money to move the markets, and I'm looking to buy gold. The current market price for gold is $2,000, and as a bank, my goal is to make money, and buying at the market price isn't the best price to get in. So what I can do here is to take out $1 billion out of my $10 billion in cash to sell gold. This causes price to dump lower. And let's say price of gold falls to $19.95. The retail traders are saying that price is falling aggressively, and they get FOMO, fear of missing out. They get into a short as well, further pushing price lower to, let's say, $19.90. Now, as a bank, a $10 discount on gold is a discounted price, and it is a good enough price for me to get in to buy gold. So what I'll do is I'll pump my other $9 billion into the market to buy gold. This causes a massive pump in gold prices to, let's say, 2020. The reason being, the size of my buys is significantly larger than my sells. So overall, I'm still in profit as a bank. Now, this act of manipulating the market from 2000 to the 1990 level is what we call an order block. Now, there are 2 types of order block: a bearish order block and a bullish order block. A bearish order block forms when price pumps higher first before melting downwards past the initial price where it started to pump. So what I can do here is draw a box around this area. So when price start to manipulate all the way to the end of the manipulation. Similarly, for a bullish order block, it forms when price dumps lower first before exploding upwards past the initial dump. So I can draw a box around it and label it as my order block. These order blocks are great areas to look for buys or sells from, respectively. Now, what happens when an order block fails? This usually means that the market is about to reverse its direction, which brings me to my next concept: breaker blocks. A breaker block happens when an order block fails, and there are two types of breaker blocks to take note of, similar to order blocks. The first type is the bullish breaker block. A bullish breaker block happens when price is in a downtrend and price decides to break the most recent lower high, which also invalidates the latest bearish order block as seen on the charts over here. So when this happens, the bearish breaker block becomes a bullish breaker block, where we can look for potential buys to continue higher. The second type is the bearish breaker block. It forms when price is in an uptrend and price decides to break the most recent higher low, failing the bullish order block. When this happens, the bullish breaker block turns into a bearish breaker block, where we can look for potential sells to continue lower. Now, if you still do not understand how these concepts work, please rewatch this part of the video, as it is vital for your understanding in order for you to execute the strategy. So now, let's break down the ICT breaker block strategy into 5 simple steps to follow. Anyone, regardless of how new you are to trading, can use this strategy to finally become profitable. For this strategy, I'm only using the 15-minute time frame to analyze and execute my trades. So just focus on one time frame, because that's all you really need. So for the first step, determine your overall trend of the market on the 15-minute time frame. This helps you decide whether you're looking for buys or sells. Now, you can do this by marking out your highs and lows on your chart. If you see higher highs and higher lows, you have an uptrend. Now, if you see lower highs and lower lows, you have a downtrend. Let me give you an example on the chart. As you can see on the Euro-US dollar chart, there are higher highs and higher lows forming. This indicates that this pair is in an uptrend. The opposite is true for a downtrend. Step 2. Look for a market structure shift in the opposite direction of the trend that you identified in step 1. This means that if you're in an uptrend, you want to see a market structure shift lower, breaking the most recent higher low with a body candle close. Now, if you are in a downtrend, you want to see a market structure shift higher, breaking the most recent lower high with a body candle close. Step 3. Mark out your breaker blocks on the chart. So how I'll be marking out my breaker blocks is by drawing out where the failed order blocks were. In an uptrend, I'm looking for a failed bullish order block, and in a downtrend, I'm looking for a failed bearish order block. Now, once I have marked them out, I can move to step 4. Step 4. Wait for price to retest the breaker block. What I want to see is for price to close with a body candle closure within the breaker block. This is extremely important, as a wick retest doesn't present a proper retest, and price could potentially come back in the future to retest again. Step 5. Enter a trade with stop loss covering the entire breaker block and target a simple 1:2 risk to reward ratio. The reason for a 1:2 risk to reward ratio is that this strategy is meant to give you a quick scalp in the market, allowing you to get in and get out just in a couple of hours. Now that you have the exact blueprint of how to execute this ICT breaker block strategy, let's go onto the charts and look at some examples of how the strategy works. Here on the 15-minute pound-yen chart, price has been in a downtrend as seen by the lower highs and lower lows formed over here. So what I'm looking for is a market structure shift to the upside, breaking the most recent lower high with a body candle close. After price breaks the high after a few candles, I mark out my bullish breaker block, which is a failed order block. All I have to do now is wait for price to retest the breaker block and close inside of it before taking buys. Now, as you can see here, price closed just at the top of the breaker block, giving us a perfect entry to look for buys from. So I can enter a buy here with stop loss below the breaker block, targeting a 1:2 risk to reward ratio. Now let's see how this trade runs. Now, as you can see, price continues to run to our take profit without much drawdown. Easy. Let's take a look at another bullish example to get you familiarized with the buy setup for this strategy. Here on the same chart on pound yen, price has created a downtrend with lower highs and lower lows. Now, all we have to do is wait for the most recent lower high to break with a body candle close. Once a body candle close above this high happens, we mark out our breaker block, which is the bearish order block that failed to hold. So when price came and retest our breaker block with a body candle close, notice how I didn't take an entry on the wick, because it's a wick close. I took an entry when price came and closed inside the breaker block. This is very important. So I can place an entry here at the body candle close with stop loss below the breaker block and targeting a 1:2 risk to reward ratio. Now let's see how this trade plays out. And after a short while, price continued to rally to our take profit level for another win. Now, let's take a look at two bearish examples to solidify your understanding of how this strategy works. Here on the gold chart, recent price action has been bullish, creating higher highs and higher lows. However, price decided to break lower with a body candle close that breaks the higher low. This tells me that a market structure shift has happened and I can draw my bearish breaker block, which is identified by the failed bullish order block over here. Now, once price retested the breaker block as seen by this bullish doji looking candle over here and closed within the breaker block, I can look to place a sell with stop loss above the breaker block and target a 1:2 risk to reward ratio. It's a fairly simple trade, so let's see how this trade plays out. And there we go, TP smashed as well. For the last bearish example, we have the Canadian yen chart on the 15-minute time frame. Price was in a clear uptrend as seen by the higher highs and higher lows created. Now, once price broke below the higher low over here with a body candle close, it signals that a reversal is incoming. So, I mark out my bearish breaker block that is pretty clear as seen over here, the order block that failed. Once price retested the breaker block and closed inside of it, I took a short with stop loss above the breaker block, targeting a 1:2 risk reward ratio again. And now let's see how this trade plays out. This trade consolidated around our entry for a little bit before aggressively dumping lower and smashing our take profit. Simple. Now that I've gone through the entire strategy with you, there are two important pitfalls to avoid to increase your win rate with this strategy. Pitfall number one, avoid trading or taking trades when there is high impact news incoming. If you're new, you can always visit forexfactory.com to check the news for the day and the timing of the news. What you want to do is to avoid trading the times where there are red folder news. These are your high impact news. It is not worth risking a high probability trading setup with news that is unpredictable, so it's better to preserve your capital and wait for an opportunity outside of news timings. Pitfall number two. It is important to note that managing your risk, like putting your stop loss to break even when you're at least a 1:1 risk to reward ratio up in profit, is really important. This removes the chance of you losing a trade when you're already up in profit. Doing this will definitely increase your win rate because you are taking fewer losses. There we have it, the ICT breaker block strategy broken down in detail with 5 simple steps to follow. If you are unsure, I urge you to rewatch the video to fully internalize how the strategy works. Now, if you're someone new to trading and needs guidance on your road to profitability, join our free Telegram group with close to 40,000 members. We share free signals and educational content on a daily basis. So to join, click the first link down in the description below where it will lead you directly into our Telegram group. Don't forget to smash the like button and subscribe to our YouTube channel to keep updated when we upload a brand new educational video every single week. Also, do click on the bell notification as we go live every single day, 3 times a day during Asian, London and New York. So don't miss out. I'll see you in the next video. Nick signing out.